What we're going to talk about today is some of the perils or pitfalls of infinite banking. Okay. And this is going to just be things that I've seen and that I've talked to Nelson about, etc. Right. I would say the number one thing is, Nelson says it's simple, but you can get caught into the wrong simplicity. Okay. So what I mean by is like misapplication. It's like something it's not trying to make it what it is, but something that it's not. And kind of like IBC is one size fits all. Like, hey, you use it for your cars or something like that. Like Nelson emphasized that it's a process, not a product. And a lot of times people want to talk about it being a policy, but it requires strategic thinking, funding, and discipline. I mean, there's to make it like there's this magic life insurance policy that just is, it's going to lead to like disappointment. You're going to be like, well, why am I using this? It doesn't, because you think, oh, I'm getting this percent or this return inside the policy. So Nelson stressed that, just having a whole life policy is not the same as becoming your own banker. And you have to use the loan provisions and you have to reinvest cash value properly. You have to have the right PUA and everything else. If you skip that kind of what your goal is, what you're trying to do, paying back the loans, if you skip all of that, you're in trouble. And there's a larger picture to it. Infinite banking is the banking function. Going out and buying cash flowing assets, etc., is really the act of being your own banker, right? And so one of the pitfalls that I see people doing is they get too hung up in the illustration. And there's a lot of life insurance agents out there that talk about infinite banking, but they really don't know much about infinite banking. And they want to talk about how their policy is better, which leads people to buy universal life, which is the worst thing you can do if you're going to do infinite banking. The second worst is they're going to structure the policy wrong. Okay, so number two, the second pitfall is improper policy structure. Now, what does that mean? Is we're maximizing early cash value with paid up additions and minimizing the death benefit, but also in the end, we want to have more base premium that is more efficient. I'm not a huge car guy. I mean, I like nice cars. The PUA is like the turbocharger and the engine is like the horsepower. And I'm smiling because now that's not how it works. Now it's hybrid, right? The PUA is like the battery part of the engine, and the base policy is like the gas part of the engine that really gives it so the one thing gets it off the starting line fast, that's the battery or the PUA. And then the other thing, the horsepower of the engine, gets it to top speed. So it has to be to where you're focused on cash. Most people would not just go buy a base whole life policy and use it for infinite banking, because it would take probably 7 to 10 years for the cash value to really build up. It doesn't really take that long, but like people think that it does. And then, people want to talk about mechs and different traps. You got to work with a coach that's going to help you and make sure that the company is making sure that you're good. It's, you want a balance of PUA and base premium. And if you have a balance in there, every illustration system with every company tells you whether it's a mech or not. There are other things down the road that could affect it to make it a mech. If dividends go up or down, you may have to adjust. But that's where the company and your infinite banking coach comes into play. And that consistent monitoring of policy corridors and making sure that we're working with underwriters and compliance to make sure that there's no accidental mech events. But you have to sign off on something. Okay, so the third thing is cash flow and liquidity mismanagement. Taking policy loans without a plan for repayment. Hey, I just need some money right now. Okay, so it's one of the powers of infinite banking lies in borrowing from your policy while paying yourself back with interest. Recycling the dollars. Policy owners don't systematically repay these loans, they're stealing the peas and they're jeopardizing the policy's long-term growth and can lose the compounding effect. Okay, because as you pay back that interest. if you're going to go buy a car, I just did this last Wednesday night, right? I was there 20 minutes. It was a beautiful thing. And the only extra that I threw on there was the wheels and tire protection, because the wheels in this car are like $1,500 or something. And I know that I've never, knock on wood, damaged a wheel, but if I did and I couldn't get like just one and I had to pay $6,000, something like that. So anyway, so what I did is I ordered the car 6 months ago that just came out. Comes in and he says, man, we got some great options on financing and lease. I said, hey, tell me about that. So he tells me all about it. And the only reason I want to know is so that I can know what to charge myself, because I know it's a crummy rate, right? And he gives it to me and I said, okay, thank you. Here's a check. And he goes, oh, you don't want to finance it? No. I mean, look, if you want to give me an incentive to finance it, meaning you want me to finance $25,000 and somehow you get a kickback and you want to split that with me, then we'll talk about it. But other than that, I'm just going to write you a check and here you go. Well, now I set up a loan repayment exactly the way that they were going to charge me. Now, also, if I wanted to, I didn't do that in this car, but I could charge myself more because I'm not using the car as collateral. Okay. So, you have to, as Nelson would say, treat this with sacred obligation, like a loan from an actual bank. Right. And it's got to be disciplined. So if you over borrow, how could you over borrow? So if you're just constantly taking the money out and you're not putting money back in and you're not buying cash flowing assets, you can get in trouble. But you need to keep your available cash value for emergencies and opportunities. Right. So the other thing is, the fourth thing that people the pitfalls are screwed up is they're underestimating the long-term commitment. This is seceding from the banking system. It's not buying a life insurance policy and how long do I have to fund it for? How long do you have to use a bank? How long do you have to flow money through somebody's bank, whether it's yours or somebody else's, for your entire life? So why wouldn't you want to do that? This is where people that don't understand this, they want to RPU, reduce pay it up, a policy where you can't put any more capitalization in. You can't put any more in, right? So these are little things that people screw up. This is a long-term thing. We are using this as our banking system, right? And I've never had anyone that's been doing this 7 or 10 years, somewhere in that range, that doesn't come back to me and say, oh my gosh, this is amazing. This is, and so what are the pitfalls of that long-term commitment is when dividends go down and they go up and down throughout time, is listening to some insurance salesman on, hey, you should swap out your policy for some projected higher rate of return. So again, that's not what you want. Number 5 is focusing on this. I mean, all the things that we just talked about are about the insurance contract. And it's really banking as the cornerstone of your financial strategies, right? Or your business development, your tax strategies. It's like all of these things. So it works best with, if it was just by itself, it'd just be a life insurance contract. But we have to work in tandem with investments, business ventures, flowing strategies of every kind. And that financial growth can be fostered through the infinite banking system. When you're leveraging policy loans to go buy something that's going to cash flow, now it really blows up, right? And the best use is not consumption, but cash flowing assets. Okay. And again, then all these policies, because this again is a long-term thing, is going to be used for estate planning, legacy planning, all of that, right? And all right, 6th thing that people do, they just get the wrong agent. And they're every time that I've seen this, I've seen it, I don't want to say 100 times, but it's probably 100 times, is somebody says, oh my gosh, this is a great way to sell life insurance. And they don't get it. And so what they do is they learn just enough to convince somebody that's not an expert to take out a policy. And then those people in 3 years, 5 years, whatever it is, they call us and say, hey, this is screwed up. Can you help me fix it? And it's more commission driven, right? They're trying to create an annuity. Like they want you to pay them forever, right? So that's number 6. The 7th one is really the psychological hurdles. Not treating it like a bank, and a bank would make you pay back the loans, right? With interest. So why would the commercial bank's money ever be worth more than your own money? And why would you pay the commercial bank, but you're not willing to pay yourself? See, that just doesn't make any sense. And so you have to have that kind of moral compass and financial duty to repay yourself with interest. Don't steal the peace, right? So how do you do that? Set up automatic payments. Don't say, well, I'm going to put in 50 grand when I get, that's hard. Just try to make it consistent. Even if you're going to do a balloon payment in 3 years or something, right? And then realize that interest rates, market volatility has nothing to do with this. Banks really don't care that much about the market volatility and everything else. So when the stock market surges up, you might think, my gosh, I got money parked in this whole life policy. I could have it in this, right? And then when it goes the other way and interest rates go up or something, they panic and they think about surrendering or lapsing the policy or whatever it is. And these are things that we can't have, but those are short-term thinkers, not long-term thinkers that are looking at long-term outcomes. Don't chase short-term gains. I know it's hard. The consistency and the tax advantages will, in time, I always think, don't think get rich quick, think get comfortable slowly. And then, sometimes people will say, well, what about the insurance companies? These are things there are little insurance companies out there that have, reduced dividends and they've bought business and, and then they can't pay, there are that. But you want to find a good mutual insurance company, not just with ratings. Okay, you got to look at the financials. This is where when you hire a firm like Create Tailwind, we've done all of that. But it's not ratings. AIG had 100% Comdex 30 days before it was insolvent. What that means is they had the best ratings everywhere. And 30 days later, they were insolvent. And guess what? We got to bail them out. Why? Because they had a derivatives division that almost took down the largest insurance company in the United States. So would I really have a small company that doesn't have those exposures and also has a great balance sheet? Yes, I would. All right. So sometimes if there's changes in the law, so you think there's pitfalls, every time that they've changed the laws, they've grandfathered the people that are already in. Just like there is no MEC before 1986, right? There is no MEC or 88. Was it 86 is when they adopted it? 88 is when it took place, or when it was put in place. They agreed to it in 1986. So before that, you can just put $100,000 into a $100,000 death benefit policy, right? Okay, so they grandfathered everybody that had those. And anybody that I ever see that has them, I say, don't get rid of that. All right, so number 9 is opportunity cost misconceptions, okay? You have to look at all opportunity cost and, showing premiums that going in the policy as capitalization and knowing what the cash drag is going to be, designing the policy where that cash drag is our investment in our business in the very beginning. But very quickly, every dollar I put in, I have more than $1 to use. And so there is no lost opportunity cost after that cash drag, right? And it's always compared to what, right? That, compared to what? Compared to putting my money in a Wall Street-based account and all of these things happen, is that interest is a cost of capital. And it's covered, should be covered by whatever you're investing in or the business return. Okay. So no, it's a cost of doing business. And as long as you're investing in something that's creating more cash flow than what you're paying for the policy loan, then you have a spread. The bigger that spread, the bigger the profit, right? Okay, so the last pitfall is implementing IBC without sufficient cash flow or time horizon. I see this all the time. Like, hey, I've got this amount of money sitting in my account. Like, how do I transfer it and put it over? Blah, 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 right? And if you're very tight on your finances, then your premium can't really be robust, big, because we don't want to strain your financial system. We want to enhance it and grow it. And we start where we start. And you have to be in a position to fund whatever policy you took out comfortably. Like make sure that your time horizon is in line with building this insurance contract and your liquidity needs. I've had people go, well, yeah, I didn't realize I was going to need that money. Okay, well, like in the beginning, we need to do that. And, part of the, like when it's not suitable, sometimes even is underwriting, right? It might not be suitable if you're rated. It just might not be efficient enough. And we might have to write the insurance on a business partner or a spouse or small policy on you and small policies on everybody that you have insurable interest with. So kind of to wrap that up is kind of poor policy design, mismanagement of policy loans of some way, unrealistic expectations or time horizon could be too short, and working with untrained advisors and failure to integrate the policy and infinite banking concept into these, into these investments, okay? Because everybody that is a client of Infinite Bank or Create Tailwind, you've seen our ledger. Can't have the left side of the ledger without the right side of the ledger. If you don't integrate the right side, then you're probably in trouble, okay? I hope you guys have a great week and Godspeed. Talk to you soon next week.